Today we are analyzing Hewlett Packard Enterprise Corporation, ticker HPE. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company has a market cap of $19.6 billion, enterprise value of $24.6 billion. This company is operating the technology, hardware, storage, and peripherals space. So they looks like they have about $5 billion in net debt, which is about 20% of the enterprise value. So this is a quite indebted company. So HPE provides solutions that allow customers to capture, analyze, act upon data seamlessly. That means nothing to me. 6 segments: compute, HPC, storage, intelligent edge, financial services, corporate investments. They have general purpose servers. So there we know, okay, they're making some servers for secondary workloads, modular storage arrays, edge systems. The company provides hardware products. So I don't know why they don't just have hardware products at the beginning. Wi-Fi access points, switches, gateways. They have some cloud-based management solutions. It also offers leasing, finances, IT consumption, utility programs, and some consultant services. So this company is doing a lot of different things. It looks like it's primarily on the hardware space, as well as some solutions, but I'm thinking more in the space. They're producing the hardware, they're marketing and selling the hardware through a few different methods, whether it's leasing or direct sales as well. So doesn't sound like a very strong industry unless they have really good pricing power, but I would be surprised if they did. This sounds like an area, especially because it's enterprise, perhaps focused, where you'd have very cost-conscious customers. So we'll see how that plays out. So you have a beta of 0.124, about 25% more volatile than the average S&P 500 company. Not a significant difference. So nothing I'm going to worry about too much there. Now we only have data going back to 2012. So I'm assuming this is some sort of spinoff in 2012, or I'd have to do some further research why we don't have data going back for 20 years, as is typical. But if we just look starting in 2013, we can tell a little bit about this company. You see some cyclicality in these results. You're going up and down quite a bit. And these cycles are pretty short. I mean, in 3 years, you're going to, 2 to 3 years, you're going up to new peaks. So that's a lot of cyclicality, very short life cycles in this business. Looks like we started out 10% return on invested capital, go down to 4, 5, 6, 0, 5, 3. They lost money in 2020. Again, that was COVID, so I can give them a little bit of pass there. And they got back up to 10% in 2021. Overall, it looks like they're hovering around this 5% line. Not great returns on invested capital, but they only have one loss in the last, decade. So that's not terrible. One loss in a decade is not terrible. But overall, probably average results here. Kind of some cyclicality, some okay returns, nothing amazing. I'd really love if they were above this 10% line for most of the period, but they only had 2 years hitting 10% or more. So with on 10-year median returns, we see return on invested capital of 4.8%. That's a bit low. Again, I was saying, very clearly it's hovering around that 5% line. I would really like 10% plus return on invested capital, because what I need to really get my 10 to 15% returns as a shareholder is I'd really like my return on equity to hit a 15% number. And so when you're seeing these numbers here in the single digit range, it's telling me this is going to be a hard company to hold over the long term in order to achieve my target returns. And so that's what I'm seeing here. Now, there's ways that you can trade companies like this, but it's automatically going kind of like, I'm not going to hit my long-term hold returns because I am really capped on the upside of my personal returns by the return on equity. If the return on equity is 6% and I need a 10 to 15% return, it's really hard to hit that. So just something to be aware of. Now, the PE here is 22, which is quite high for a company with these sorts of results. So you're paying a very high price for a low quality company, low to average quality company here. And so I'd much prefer, buying this company at something like a single digit type PE that would allow me to get a potential double digit return, because I could include some margin expansion, some multiple expansion. But right now I don't have any multiple expansion that I can evaluate here. So I'd say this company is probably overvalued at this point from just this initial results. Now, the revenue is actually quite terrible. It looks like your revenue has a negative 7.3% 10-year CAGR, which means your revenue is going to get cut in half over the course of a decade. And we see that when we look here at 2013, $57 billion, going down to $28 billion in revenue. So they have lost half their revenue over the course of a decade. Now, a big drop was from 2014 to 2015. So if they had some sort of spinoff during that time frame, that could be a good explanation for that. But even when you look at 2015 results and you say, okay, you had 31 billion here, you went down to 28 billion, they still lost 10% of the revenue over that 8-year period, which is not a great result on its own there. So Your gross profit's been declining pretty significantly. It's down about a third. Operating profit down about half. EPS down about half. I'm not excited about declining companies. What I'm really not excited about is paying a high price for declining companies. So you see this price here, $15 per share. You see the 66 cents in earnings. Again, very high price. It looks like probably the trailing 12 months is a little higher than that in order to hit our 22 here. But regardless, if you have a company that's declining in earnings, you can make money off of it, but you need to pay a really low price. And because it's declining at this rate, where you're saying maybe you're losing half it in a sort of a decade, depending upon your capital allocation, you can make that work. You can do really well with a company that's declining, but it needs a few key things. And the first thing for me is it's going to be a low valuation. Low valuation means single digit PE. Likely something in the PE range of a 5 would be where you could start to get interested in something like this. But overall, this company looks extremely overvalued based upon what I'm seeing here. You can just see the fact that they've had these declining results. Now, one positive that I do see here is that you have your gross margin percentage at 27% to begin the decade. You end at 33%. So they've been able to increase their margins over time, probably facing a little bit less competition. So despite the massive impacts of a shrinking business, they're able to maintain a little bit better pricing over the course of this decade. The operating profit has also grown from 6.9% to 7.6%. So the business is holding up decently well despite these concerns. They're paying out a lot of their money in dividends. Of course, if the business is declining, this is just, basically saying, hey, we don't need the capital. The business is shrinking. So that's an understandable way to do that. If you're enjoying this video, hit that like button. Again, likes help let YouTube know that you're enjoying my content, not necessarily about this particular video. So I would really appreciate your likes and subscriptions. So let's go in and see what else we can learn about this company on the income statement. Gross profit, again, we've already kind of touched this. You see this massive drop, $20 billion coming out of the cost of goods sold line. They're selling a lot less product now than they used to. The one thing that's really good here is you can see that they've intelligently managed their SG&A. They've been able to take out $3 billion in SG&A out of the business. Again, I'm looking like I have some sort of spin-off here in the 2014-2015 timeframe, because it's not normal that you would see $3.6 billion in SG&A just take out of a business. But what's really great is that they've been able to, pull out or maintain SG&A flat over the course of an 8-year period, despite a struggling business environment. That's really hard to do. A lot of businesses get in trouble because they allow their SG&A to grow, even though they're not able to grow their revenue. So this requires a lot of diligence from management in order to pull that off. So that's a really positive sign from the management side. They're doing a lot of R&D, but it's not really playing out into the operating profit line. So they're really treading water here on these numbers. Now, one thing that is good is you see that the shares outstanding have declined significantly over time. You had 1.8 billion shares outstanding. You're down to 1.3 billion shares outstanding. So something like 30% of the shares outstanding being retired over the time. That's going to boost your EPS by about 3% per year. The problem is the shares outstanding are going down slower than the earnings. And so you're actually getting worse and worse and worse. This is kind of like a doom loop on the company. If they continue to throw money into buybacks, but it's not able to buy back shares faster than the decline, then the shareholders really aren't getting much from it. This is a really tough environment for you to make money as a shareholder owning a company like this. Let's see, accounts receivable. Let's look at assets. So one of the things that you want to see is their assets going down a lot. So like we said that their revenue's fallen by 50%. We said that their income is falling by almost 20% or 50%. So you'd want their assets to fall by faster than 50%. The problem is that your assets were $68 billion to begin the decade, and now they're still $57 billion. So your assets are not dropping fast enough to justify this. What you'd like to see is that these assets are dropping at 10% a year, while revenue is dropping 5% a year, earnings dropping 5% a year. That means that you're able to pull a lot of capital out of the business, and that capital being returned to shareholders could be a way for shareholders to get those double-digit returns, but we're not seeing it here. A big lead weight here, of course, is your goodwill, $25 billion to $17 billion. A lot of that's not necessarily going to go away, but even if you just isolate it to PP&E or inventory, you're not seeing the drop that you'd want to see. Pension liabilities, they have a pension too. Owning a declining company when you have a pension, is just a disaster. It looks like they must have frozen the pension, though, because the pension liabilities are going down over time. That is a good sign. A bad sign is that their long-term debt has gone up. So you actually have more liabilities now than you did in 2013, $37 billion versus $30 billion. You now have $8 billion in debt. That's a lot of debt on a business that's struggling to grow profitability. You really want your debt to be gone in a situation like this. So I don't like how that balance sheet is being managed. Cash flow statement. Net income, $2 billion. You're down to about $1 billion. Cash flow from operations is much higher. So this is one of those things where it's like, depending on how you manage your working capital, your assets really matters, because your depreciation and amortization is this big gap here. All those assets, you should be able to just allow to depreciate over time. You want to be reducing your asset intensity, but they're still investing a lot in assets, $2.5 billion, $2 billion, $1.6 billion. That's a lot of investment, and that's very similar to how it was at the beginning of the decade. You want to see that investment cratering in order to manage a declining business like this. But what this is telling me is that they have to put that investment in, or the business would have gotten even worse. So that's a big red flag for me as well. Another thing is you have stock-based compensation in a business that's not growing. This is just a disaster for shareholders. You're giving away shares that you're then having to buy back with your share buybacks, even more expensive there. I'd really love to see the stock-based compensation go away. The employees haven't created a lot of shareholder value in this decade, and so why are they getting a lot of free shares would be one way I would think about that. Net issuance of debt. Of course, you're issuing a lot of debt. I don't like that. And again, if this cash could save the business, you'd want to keep it in instead of paying out the dividends. If it can't save the business, then yes, pay it out, because this company is really struggling. I actually don't like where these buybacks are going, because I'd rather just pay it out in dividends, because of how they're not able to buy back at good enough prices to justify them, because the company is deteriorating faster than the buybacks are retiring shares. So if those buybacks could drive EPS growth, that would be one thing, but the EPS has declined over time. Overall, I'm going to avoid Hewlett Packard. This company is declining very quickly. Anytime you own a declining company stock, it is risky. It's especially risky if the earnings per share are not growing. So a good way to buy a declining company is if the revenue is falling, but they've managed to make the earnings per share go up for whatever reason. Declining asset intensively, reducing debt, reducing costs faster than the decline. If you can manage that, or you can maintain it, that is one thing. But that is not what's happening here. And then on top of that, you're paying a very high price of PE of 22, when a company with these sorts of financials should trade for a PE of like 2 to 5 for something like fair value, to give shareholders a chance to get market matching returns. I don't think you're going to match the market owning Hewlett Packard Enterprise. And for me, that is the bare minimum for consideration. And for that reason, it is not hitting my watch list. If you enjoyed this video, hit that like button. Don't forget to subscribe. And if you want to see the companies that really hit my watch list, check out the watch list video list up above here at the end of this video. And if you like this software, you want to learn how to study companies in 10 minutes just like I do, my affiliate link to quickfs.net is in the description below. Please use that link to get a free or paid account. It's a great way to check out stocks. I hope you'll check it out. Thank you for listening, and until next time, stop paying fees, start building wealth.